Now, as we go into segment 2, we always want to look at a brief summary. You know, what are some of the things that are happening right now when we look at finished motor gasoline, kerosene, jet fuel, distillate, residual. So we want to look at these mobility pieces, which, you know, obviously these are big for moving around the world, whether they be by ship, by air, by truck, by car. So these are some of the key components. So when we look at what things are right now, so last week, if you remember, demand was 13.5 million. There, it's up to 14.65. Kind of that natural bounce. You know, it's a little bit high. We think that comes right back down to the average, which is right at about 14.4 million. So when you look at the average, that's below where we were in 2019 and 2018 and a bit above where we were in 2020. So right now we think we're essentially going to kind of split the uprights right here between 2020 and 2019. And where we see this kind of fitting is this gradual move down, still above that 14 million, you know, but when you look at where the demand is, you know, jet fuel continues to be a bit on the softer side, gasoline as well. We see that continuing just based on how cold it is, where we see some of these storms. Typically, for a storm, you get a little bit of a bump, and then you get that drop as just people can't really drive or don't look to drive as much in snow, and they just shift things. So then you get a little bit of a makeup number once the weather gets a bit better. So again, these are some of the pieces that we have to look at, and it's one of the reasons why we use the average is to try to get out some of that noise that continues to be in the numbers on the lumpiness side. So here you can see the average for where we were in 2022, where we started just carrying it over from the December period. You can see that steady move down, and now we see this just grinding a bit lower and closer to about 14.3 over the next few weeks. So when we look at distillate had a drop of 1.43 million barrels. That brings us 24.4 million below the 5-year average. So still very bullish position. The drop, again, about half of it still is being caused by Pad 1. Pad 1 had a drop of 930,000. That brings us 12.6 million below the 5-year average. You know, Pad 3 was we're about 8.7 million below the 5-year. We're going to continue to get these little builds. So when we look at distillate right now, imports remain elevated. When you look at just where the flow is, it's 61,000 barrels a day above the 5-year average, 91,000 barrel a day increase. This is what we were saying when we saw 2 big cargoes coming over from Europe. That will continue. It'll be lumpy just based on where things are. You know, even though fuel oil, I should say gas oil remains tight in Europe, but you're starting to get a little bit of looseness in the market, just a touch when you look at where some of the flows are, and that'll continue to kind of back up into the Atlantic Basin. And the U.S. still remains a massive bright spot to bring a lot of this product in due to the price. When you look at the trend, you know, right now the trend is typically lower, especially as we have that heating demand. Right now, when you look at production was down just a touch by 15 basis points. We expect that to really accelerate and really get closer to about 31 to 31.5% on a yield front, just because that's where the price is, that's where the demand is on diesel, road diesel, heating oil. So we expect that again, that overweight into the disty side, but by doing that, you're always going to increase your gasoline cut, and that's going to have to be something to manage as we go through the next few weeks. So when we look at products demanded, we expected to see a seasonal spike. We got it. Now from here, we expect to see a little bit of a drop, but again, still stay above the 5-year average, just remain essentially at the high end of this cloud. Let's call it about 4.4 in terms of where we sit. But again, still a lot of demand, still a lot of pull through. Here's one of the examples. Trucking demand still remains high. We're seeing it still remain elevated, pushing back to the upper end. We don't see it getting back to 200, but again, just still staying at this elevated level. You can see load availability still going up. There's still a lot of stuff to move throughout the U.S., still a lot of demand. And when we look at what is coming down the pike when we're talking about supply chain, still a lot of stuff off the coast to move through the system. So then when we look at U.S. rail traffic, picked up a touch on the total carloads, slightly above 21. Coal is going to remain the bright spot until we kind of get to a more normal seasonal average. So we see an outpace of coal versus where we were last winter. So that's going to be the elevated front. Grains is going to remain strong. Again, it's just going to be some of that timing side. Motor vehicle parts, something, again, that will start to kind of grind higher, especially given where we are on the shortfalls on orders versus deliveries versus production. And then when we look at petroleum and petroleum products, that will remain a bit of an overhang, just given where some of the flows are and where some of the tightness resides. But intermodal should see some love as we go through the next few weeks, and it's really tough comps, especially when you think about the first month of 2021. So that's going to, again, just a tough comp level. It's still high, it's still elevated, but we're still seeing a lot of those bottlenecks that we talked about on the rail side, which is why trucking still remains some of the preferential moves of these products through the system. Now, when we look at what's coming down the road, you can see that we're still up from previous week. And then as we get into the end of January, you can see that the boats continue to pile up. We're still at a record. We talked about it in the Econ Show segment 1. We still have a record amount of cargoes sitting off the coast of both LA and Long Beach. Now, on the heating oil front, you can see that essentially everything from I shouldn't say the Rockies, but halfway through Texas, all the way north to North Dakota. From everything east, you can see that there is a lot of cold coming through. And where the heating oil is the biggest demand is in the Northeast. So clearly you can see that there's going to be a significant amount of demand in that region, which is going to keep things fairly tight. The heating degree days are going to remain elevated. This is going to put things into a fairly bullish backdrop, not only for heating oil, but also natural gas consumption in that area. But when you look at just where heating oil is and the competition it has with the trucking sector, we're going to continue to see price increase. We're going to continue to see this be a fairly strong movement. Now, when we look at gasoline stock, gasoline built by 5.87 million barrels. That's only 2.7 million below the 5-year average. We continue to kind of walk up that ladder. And a lot of that is just because of the production within the U.S. Like the production was actually up 3.6%. But that's really flat versus the 5-year average. So it's just a matter of, as distillate becomes the target, we're going to throw off additional gasoline. And the gasoline market, globally speaking, remains glutted. So there's really no avenue for export. So a lot of this is going to be stuck in the U.S. It's not unknown. When, as we talked about in segment 1, it's very normal to see elevated builds this time of year. And the fact that we're seeing imports slow down will help kind of keep us balanced. We expect to be just below the 5-year average on imports, but also Europe is seeing elevated imports. So we're going to have to see, Europe's going to try to manage some of that flow, as will the U.S., and that's going to be something to watch as we go through the next few weeks. But again, I expect us to be at about 400 to 425,000 barrels a day of imports on average for the next 4 weeks. But we should see one more drop before we see a little bit of an increase on the import front. Now, when we look at mobility, looking at Google, when you look at the index January to February of 2020 on the 7-day moving average, you can see that we're pretty much depressed across the board. It's really just a mixture of COVID, mixture of weather, and there has been a lot of delays for returning to the office to essentially February 1st or at least the first week of February. So that's going to keep a bit of an overhang. When you look at China had a little bit of a spike, but again, we expect to see a pretty sizable drop as we see pressure on the movements for Lunar New Year. And then the Apple mobility side continues to remain fairly stagnant versus where we were over the last few weeks. Now, when we look at Gas Buddy, if you remember last week, we were saying that the average in general was going to move up and down about 1%. Here we had a little bit of a bigger move. U.S. gasoline demand rose 1.8% from the prior week, but was still 2.9% below the 4-week rolling average. So again, we just expect to stay within this fairly tight range. We expect to see a little bit of a drop and then a little bit of a bounce, just given where the weather is right now. We could get maybe one more increase, but it'll just be a little bit of this back and forth in terms of maybe next week's 50 basis point increase and then a 1% drop. But again, staying in a fairly tight band as we go through the remainder of January. And one of the bigger drivers is when you look at gasoline and diesel prices. So when we look at gasoline, it was up another penny. It's now just above $3.30. Excuse me. We expect to see this continuing to grind up. It should get to about $3.33 over the next 2 weeks. And it's just because of where where crude prices are, refiners trying to pass through some of that additional cost as it costs them more in general. Diesel is approaching, almost had a 7-cent increase. It's now at $3.725, so almost at $3.73. And this is the bigger issue. This because diesel, again, looking at road diesel, looking at heating oil, this is going to be that biggest cost to the consumer, because not only are your heating needs and heating costs going to go up, but you're also going to experience this on the shipping side, on the trucking side, and this is going to keep prices elevated when you look at how it impacts the consumer. So not only is inflation going to, again, have a little bit of that bid to it, but you're also going to get hit fairly hard with the gasoline side moving up again. Now, when we look at blending components had a build of 5.27 million. That is now 3.7 million barrels above the 5-year average. We expect this to just look just almost exactly like 2019 and see these elevated builds, especially as more of the blending stock gets left in the blending pool. Now, when we look at gasoline, here you can see we had a little bit of a bounce above 2017 levels, but you can see we're still below the average for the last 5 years, and we expect to stay below the average. But when you look at the trend still shows up. We just expect this to flatline a bit and stay a bit depressed, which is going to make it look a little bit worse versus the 5-year average, but still just moving right between where we were in 2017 and those 2020 numbers, essentially like splitting those uprights going right through there. And that's going to be more weather related. When you look at 2017, there was a weather impact. So again, it's just going to be some of that recovery, but it takes a little bit of time, especially as the mid-Atlantic gets hit with more snow. They're not exactly equipped to handle it, which usually results in a bit of a depressed gasoline market. Now, when we look at some of the shifts here, you can see that transit stations remain low, residential just showing that people are still staying home, working from home. Workplace, a little bit of a bounce, but still fairly depressed, as parks, retail, recreation, grocery, pharmacy stores, all of that remains below normal. And a lot of that, again, is weather-driven, Omicron-driven, so we expect that to remain over the next few weeks. When you look at where we are versus baseline, looking at Apple mobility trends, things still are holding fairly firm, and we don't see that adjusting too much on the European front or the U.S. front. Propane, propylene, still right now splitting the uprights between 2019 and 2018. We expect that to continue. We had a draw of 3.69 million. That's now only 8 million below the 5-year average. And the reason why I say that was because previously it was 8.3. So the comps get a little bit easier because when you look, it's a clear drop. Like, we're going to continue to draw. The question is always going to be, what is the rate of drop? What is the rate of the draw? What does the slope look like? And does it soften? Does it accelerate? Based on some of the shifts that we've been talking about, it should ebb a bit as exports slow down a touch. But that's where we expect to see some of that additional some of those additional pressures. Now, when we look at days of supply for propane, still remaining tight, it's going to be important to see really what are exports going to do. That's going to kind of be the bellwether of, do we continue to move closer to where we were in 2018, or do we kind of stay right in around this range and move sideways a bit? Now, when we look at jet fuel had a small build of 210,000 barrels. But when you look at demand, as we said last week, we expected it to come down. It came down. We should get a little bit of a bump, but just because of the pressure that we're seeing from 5G, from availability of personnel, from slowdown looking at TSA passengers, we could actually see one more move down before we see a move up, as there's going to be some excess jet fuel on site. And this is what we're talking about with the TSA passengers. You can see that we're still well below where we normally are versus 2020 and 2019, because remember, 2020 didn't start to slow down until March. So we expect to see this fairly low capacity. But on a seasonally adjusted level, seasonally speaking, we typically have a slow period and then it accelerates through March. So we do expect to see this remain fairly depressed, and we do expect to see this rebound a bit as we go into March and April, very much along seasonal lines, but still below what should be normal versus 2019. So I'm saying that now because people are gonna point to this rebound as winter break starts and spring break starts and saying everything's back to normal. And I'm just prefacing the fact that we will see TSA passengers increase. It'll be along seasonal lines, just at a reduced rate through 2019. Just wanted to highlight that. Now, when we look at the 12 weeks here, you can see that there was a drop of about 1.7%, versus with the biggest drop being in China. When we look at the 12 weeks ahead, so that's something that is going to continue as we have those pressures from not only Omicron, but also just some of the lackluster movements around the world. Open table, as we were saying, we were expecting to see a sizable drop just given both weather and the spread of COVID. So here you can see on weekends, we're dropping now about 15 to 20%. And weekdays, we're seeing drops from anywhere from 25% to about 35%. And that's something that we think persists through the end of January and into the first week of Feb, just showing some of that activity, again, waning a bit. So that's what we have for you on the U.S. front. Now, in the next segment, we're going to go a bit broader and look at some of the things that are happening around the world.